Welcome back to the deep dive. Today we're unpacking a puzzle that's, well, it's one part history lesson, one part high-tech transformation.
And one part psychological thriller.
Yeah, exactly.
Okay.
Especially if you're a trader with sweaty palms watching the charts. We are looking at Kirloskar Brothers Limited, or KBL.
It is a fascinating case study. I mean, you have a company established in 1888. Think about that for a
In
second.
1888.
That's pre-independence India. It's before the Eiffel Tower was even finished. And this same company is now trying to reinvent itself with, Industry 4.0, smart manufacturing, AI.
It's wild to think about a company surviving that long. They've seen world wars, the end of empires, the internet boom, and now they're dealing with algorithms.
Mm-hmm.
But here's the hook, and this is exactly why I wanted to dive into this today.
Okay.
We have two very different piles of evidence in front of us, and they seem to be shouting at each other.
The classic signal clash. It's one of my favorite scenarios to analyze because it forces you to choose a side, right? Do you trust the market sentiment or do you trust the corporate report?
Exactly. So on one side, we have a technical analysis of their stock chart from early February 2026. And let me tell you, it's flashing some
Serious warning lights.
It is. It's nervous. It's volatile. It's acting like a cat in a room full of rocking chairs.
And on the other side, we have their fresh Q3 FY26 investor presentation, which, it tells this glossy, confident story of operational efficiency and massive transformation.
So the mission for this deep dive is pretty clear. How does a manufacturing titan navigate a sell signal on the charts while simultaneously claiming that transformation is not a destination?
I love that quote. Transformation is not a destination. It implies this perpetual state of change.
It really does. It sounds like something you'd see on a motivational poster in a Silicon Valley startup, not a heavy engineering firm dealing with cast iron pumps.
Right.
But we need to see if the numbers back it up. This deep dive is perfect for the learner. Someone who wants to understand how to read between the lines of a stock chart and an earnings report at the same time.
Without getting a headache.
Exactly. So let's start with the weather report, the technical analysis.
The technical weather report. I like that analogy. So if you looked at the Kirloskar Brothers chart in early February 2026, the forecast was, let's call it mixed with a chance of thunderstorms.
Mixed is putting it politely. But I did see one detail that got me excited at first. On February 3rd, 2026, there was a gap up. Now, let's unpack that for listeners who don't stare at candlestick charts all day. A gap up sounds like a good thing, doesn't it?
Usually, yes. A gap up happens when the opening price of a stock is significantly higher than the previous day's closing price. There's literally an empty space, a gap on the chart where no trading happened.
Because the demand was that high.
Exactly. It implies a sudden burst of energy or a rush of buyers getting in before the market fully wakes up.
Okay, so on February 3rd, buyers rushed in. And in the very short term, right around that date, the stock was trading above its 5-day and 10-day moving averages. So if you were just looking at that specific week, you might think, okay, the bulls are back.
We're off to the races. Bye, bye, bye.
All right.
But, and I hate to be the bearer of bad news,
I hear a very heavy but coming.
there is a significant but. If you put down the magnifying glass and zoom out to the medium term, the picture changes completely. The analysis shows the stock is trading below its 50-day, 100-day, and even the critical 200-day moving averages.
Ouch. The 200-day moving average, that's usually the big safety net, isn't it?
It's the line in the sand for institutional investors. That line represents the average price over the last year. If you're trading below that, it means the current sentiment is worse than the average sentiment of the last year. It indicates a prevailing downtrend.
So we have to remember the context here. The 52-week high for this stock was around 2,475 rupees. That was the peak.
And we are well below that now.
So it's not just a dip, it's a correction.
It is. And when you have a gap up, like we saw on Feb 3rd happening while the stock is below that 200-day average, traders often call that a dead cat bounce or a bull trap.
Bull trade.
It looks like a recovery, but the heavy gravity of the downtrend just pulls it back down.
That's a great analogy. It's like a sprinter who trips, does a little hop to get back up, but is still way behind the pack.
Precisely. And the technicals highlight some very specific battle lines. The report identifies immediate resistance at 570 rupees.
Let's define resistance for the learner.
Yeah.
Sounds like something from Star Wars.
Well, in trading, resistance is a price ceiling. It's a psychological barrier. There are likely a lot of people who bought at 570, saw the price drop, and are now just waiting to sell and break even.
So every time KBL gets near 570, sellers just step in and push it down.
They do. So 1,570 is the ceiling.
That's the floor.
The floor is called support. And the analysis shows support around 1,537 and 1,506 rupees. This is where buyers think, okay, it's cheap enough now, and they step in. The stock is just bouncing between those two narrow bands.
That sounds stressful, just bouncing between 1,506 and 570. What about the other indicators, like the RSI, the Relative Strength Index? Is it screaming one way or the other?
That's the funny thing. The RSI is sitting right in the middle, around 49.
So completely neutral.
It's basically shrugging its shoulders. It's not saying buy me because I'm cheap, and it's not saying sell me because I'm expensive.
Okay, so when you combine a neutral RSI with those moving averages, which are mostly signaling sell,
You get a picture of underlying weakness. The momentum just isn't there.
so the chart is nervous. It's volatile.
Volatile is the key word. The volume analysis showed these heavy spikes, especially during that gap up. High volume means a lot of disagreement. There's a tug of war happening.
So the long-term trend, maybe 3 to 5 years, is powerfully bullish. But right now, the technicals are holding up a big sign that says, proceed with caution.
Exactly. The market is waiting for a reason to pick a direction.
Okay, so the charts are cautious, bordering on bearish. Now let's open that second pile of evidence, the Q3 FY26 investor presentation. Because when a stock is sliding like this, you expect the financials to be a disaster. But these headlines, they're confusing.
It's the classic read the fine print situation. If you just skim the glossy slides, you might think everything is great. But we need to look at the top line versus the bottom line.
Let's do it. The top line revenue from operations, it's actually down. They clocked in at 11,116 crores for the quarter, compared to 11,144 crores last year.
Right. That's a drop of 2.4%.
Not a collapse, but definitely not growth.
But then you look at the profit after tax, the PAT.
And it went up. PP is 125 crores, up 5.8% from last year.
So sales go down, but profit goes up. This is where a lot of improved efficiency narratives start. Investors see profit growth and think, wow, they must be cutting costs.
Right. They must be doing something smart.
And to be fair, there is an efficiency story here, which we'll get to. But the primary reason for that specific profit jump isn't operational magic.
Uh-oh. Here comes the detective moment. What is it?
It's the tax man giving them a break. If you look at the tax charge or credit line in the profit and loss statement, it tells the real story. In Q3 of the previous year, KBL paid about 32.7 crores in taxes.
Standard business. You make money, you pay tax.
But in Q3 FY26, they had a tax credit of negative 7.5 crores.
Fine, let me just, yeah, I see that. So instead of paying 32 crores, they essentially got a 7.5 crore credit. That's a swing of about 40 crores.
Exactly. It's a massive swing. Think of it like this. If I tell you I saved money this month, but the only reason is because I didn't pay my electric bill, have I really become better at budgeting?
Not really. You just deferred a cost or got a lucky break.
Precisely. So if you strip that tax anomaly out and look at the EBITDA, which measures the actual operating performance of the business, it tells a different story.
And what's that story?
EBITDA dropped by 11.9% to 161 crores.
That is the aha moment right there. The headline says profit up, but the engine room says operations down.
It's a crucial distinction. You should always check if the profit growth came from selling more pumps or from a tax adjustment. Tax credits are great, it's real money, but they're usually one-time events. They don't prove the business is getting better.
So is the whole company struggling then? Because I see these slides about enriching lives and all that. They're a massive engineering firm.
No, they're not just sitting around. And this is where the story gets really nuanced. We can't look at KBL as one single block. We have to split it into two separate stories.
Okay, what are they?
The domestic story and the international story. It's a tale of two companies.
All right, let's start with the home turf. How is the standalone business in India doing?
Surprisingly well. In fact, this is where that transformation narrative actually holds water. Even though the consolidated global numbers look messy, the standalone KBL entity in India saw its EBITDA margin jump significantly.
I'm looking at the table here. Wow. EBITDA margin went from 11.8% last year to 19.5% this quarter. That is a massive improvement.
It is huge. In manufacturing, almost doubling your margin like that is incredible. It means for every 100 rupees of revenue they earn in India, they are keeping almost 20 rupees as operating profit.
That's the lean machine part of the story. So if India is booming at 19.5% margins, why did the overall revenue and EBITDA drop?
The international subsidiaries, the group known as KBIBV, they are the drag on the parachute right now.
Let's break that down. I see a list here. SPP UK, SPP USA, Dutch entities. Who's the troublemaker?
SPP UK took a massive hit. Their revenue dropped from 260 crores down to 190 crores.
Oof, that's a steep decline.
It's a 70 crore hole in the balance sheet.
Cool.
When your UK arm loses that much top-line revenue, it drags down the whole average.
Why the drop in the UK? Is it the economy there?
The UK economy has been sluggish, and infrastructure spending can be cyclical. But it's not all bad news abroad. I see the USA is holding up.
Yes, SPP Inc. in the USA is a bright spot. Revenue went up to 150.8 crores, and the Dutch entities also saw a massive jump from 33.7 crores to 85.8 crores.
That is a huge jump for the Dutch arm, more than doubled. So you have this mixed bag, UK down significantly, USA and Netherlands up.
But here's the kicker, profitability. Despite that Dutch revenue jump, the overall KVIBV group, the international basket, had a negative EBITDA margin of 25.5% for the quarter.
Think about that, negative 25%.
So they're losing money on operations abroad.
In that specific consolidated view, yes. It seems like even where they are getting revenue growth, like in the Netherlands, it might be coming at a high cost. Or the fixed costs in the UK are just eating them alive. So you have this incredibly efficient Indian engine running at 19.5% profit, being weighed down by an international anchor that's running in the red.
That explains the chart.
How so? Tell me.
Well, remember the mixed outlook and the volatility. The chart doesn't know why it's volatile. It just sees the price jumping around. But the fundamental reality is volatile. You have one part of the company booming and another part bleeding. The chart is just mirroring that confusion.
That is a brilliant synthesis. The signal clash in the technicals, the neutral RSI, the selling moving averages, the spiking volume is basically the market trying to price in two contradictory realities.
Domestic success versus international struggle.
Exactly. The market doesn't know which narrative is going to win in the long run.
It's like the market is having an identity crisis on behalf of the company. Okay, let's dig a bit deeper into where they are making this money in India. I'm looking at the sector performance bar charts here. This is the engine room.
Right. Where is the demand coming from? The biggest chunk, by far, is irrigation and water resource management.
I see it. It grew from 843 crores to 974 crores. That's almost ₹1 billion in orders.
That is significant growth. And it makes sense. Water management is critical infrastructure in India. We know the government is pushing hard on irrigation projects connecting rivers. KBL is a primary beneficiary of that spending.
So the macro trend of Indian infrastructure is fueling this. But there is another sector that caught my eye, building and construction.
Oh yeah, that bar jumped up too, from 125 to 195. That's a massive percentage increase. What's driving that?
I imagine it's the real estate revival.
It has to be. Think about high-rise buildings. They need massive pumps to get water to the 50th floor. They need sophisticated firefighting systems. KBL dominates that niche.
So plumbing for skyscrapers and fire safety. Got it. But not everything is pumping. Oil and gas looks like it took a bit of a nap.
It did. It dipped from 209 in Q2 down to 169 in Q3. That sector is notoriously cyclical, dependent on global oil prices. A dip there isn't panic-inducing, but when you combine it with the crash in the UK, it explains why that top-line revenue looked weak.
So let's recap the fundamentals. Strong irrigation, booming construction, weak oil and gas. Now let's zoom out to the big picture strategy. The presentation has a lot of buzzwords. Industry 4.0, smart monitoring, data analytics. Is this just marketing fluff to make a pump company look cool?
It's more than fluff. It's a survival strategy. In the modern world, you can't just sell a hunk of metal that moves water. That's a commodity.
Right.
To survive another 100 years, you have to sell a system that tells you how it's moving water, when it's going to break, and how to save energy.
That's the smart monitoring part.
Exactly. They mention enriching lives, but the business application is intelligent fluid management. If they can embed sensors and analytics into their pumps, which is what Industry 4.0 is all about, they move from selling a product to selling a service.
Right, because if I'm a factory owner, I don't just want a pump. I want a pump that emails me a week before it breaks so I don't have downtime.
Precisely. That is sticky. Once a customer relies on your data and your predictive analytics, they aren't going to switch to a cheaper competitor. And this shift implies better margins.
And maybe that explains the margin improvement in India. If they're selling higher tech solutions, they can charge more.
That is a very plausible hypothesis. Higher value-add products usually carry better margins. Plus, they emphasize making India self-reliant in fluid management, which aligns with broader national trends and probably helps that domestic order book.
So we have covered the chart, the financials, the sectors, and the strategy. Let's try to bring this all together for our listener. We started with a question: how do you handle a sell signal and a transformation story at the same time?
It comes down to time frame. The technical analysis is a snapshot of current sentiment. The chart sees the revenue drop, it sees the mess in the UK, it sees the price below the 200-day moving average. It says, right now, the sellers are in control.
But the transformation story is a long game. Transformation isn't a destination, right?
Exactly. The fundamental improvements in the standalone business, that 19.5% margin, suggest that the core engine is getting fixed. If they can replicate that efficiency abroad, the stock price will eventually catch up.
It feels like the market is saying, show me. The chart is bearish because the market is waiting for proof that the international business can be fixed.
That is the disconnect. The company is saying, look at our transformation, and the market is saying, yeah, that's nice, but look at your revenue drop and your UK losses. The volatility in the chart is the friction between those two viewpoints.
So for the learner listening to this, what's the big takeaway? If you're tracking Kirloskar Brothers, what should you be watching?
First, don't just look at the headline profit number. We learned that today. That tax credit masked a drop in operational profit. Watch the EBITDA. That's your truth serum.
And watch the international division.
Crucial. Until KBIBV turns a corner, until the UK stops bleeding, the consolidated numbers will always look a bit messy.
And on the chart.
Watch that 570 resistance level. That's the ceiling. If the transformation story gains traction, the price has to break through that. Until it does, the technical bears are still in control.
And maybe keep an eye on that support at 506. If it breaks below that, the transformation might take a lot longer than expected.
Indeed. It's a classic case of a historic giant fighting a two-front war. They are fighting the technical downtrend in the stock market, and they are fighting the profitability issues in the global market.
It really makes you appreciate how hard it is to steer a ship this big. 1888 to 2026, a sell signal on a moving average is probably just a blip in their history books.
A blip, perhaps, but in the markets, blips can be painful.
True. All right, we've unpacked the charts, the tax credits, and the pump technology. Here is a final thought to chew on. We talked about Industry 4.0 and data analytics.
We did, the buzzword of the decade.
But think about the application here. If KBL is successful in making their pumps intelligent, they will eventually be collecting massive amounts of data on water usage, industrial efficiency, and infrastructure health across the globe.
That's a fascinating angle.
Right. So imagine a future where Kirloskar isn't valued as a manufacturing company, price to book, cost to steel, but as a data company that understands the world's fluid dynamics better than anyone else.
And if that happens?
The moving averages we looked at today will look comically low. But the question is, can a hardware culture from 1888 truly morph into a software mindset in 2026?
That is the multi-billion rupee question. And if the Industry 4.0 shift is real, why are those moving averages screaming sell? Is the market blind to the long-term potential, or does it see a flaw in the execution that we're missing?
A question the chart can't answer just yet. Check the tax line, watch the resistance levels, and stay curious. Thanks for diving in with us.